Those of you who saw my earlier webinar will know that I talked about the spread of noise and misinformation about the topic of investing. One of the more persistent ideas that is being acted upon right now is that investors should come to China and India because that is where all the growth is. We feel that while there is a kernel of truth to this idea, there is actually misinformation and in fact harmful information to investors in that statement. Why is that? One of the most important but least understood concepts in investing is about the cost of equity. Investors need to ensure that they price securities so that they achieve the return to equity. In equilibrium, the cost of equity equals the return to equity. An initial growth spurt results in businesses enjoying returns on equity that is in excess of the cost of equity. Almost always, businesses respond by issuing additional securities and building capacity. New entrants also enter such businesses so that in the long run, excess returns are competed away in the case when there are no barriers to entry. Temporary excess returns are competed away so that investors earn no more than the cost of equity. Growth certainly benefits society, maybe the majority business owner, but certainly not minority investors in the aggregate. When capital is mobile, the freer the capital mobility, the more the cost of equity approximates each other across geographies. So is there no truth to the idea of investing where the growth is? Well, at Multi-Act, we believe that there is one sector of the market where investors can look for both growth and the prospect of capital preservation. Those are the businesses which enjoy high and persistent barriers to entry. Warren Buffett calls these businesses moats. There are four sources of moats. The first, a preferred source of supply, either patents or mining leases or intangibles. The second, economies of scale. The third, switching cost. And the strongest, the network effect. The first two sources of the moats are limited in nature, and investors need to refrain from paying too high a price for those businesses. The last two sources of moats are more durable and persistent. While sometimes valued even those businesses highly, the durability of those moats are hard to estimate. Usually, market participants have tended to underestimate the lives of these moat businesses. Accordingly, investors have enjoyed long periods of excess returns when they invest in these true moat businesses. At Multi-Act, much of our energies have been focused on finding and monitoring these true moats and determining what their fair valuations are. We would welcome an opportunity to share our expertise with you.